Well, you're going to want to listen to this. It's a heads up to small investors. A tax trap is set at year's end that could change the way you invest. Our panel of experts is here with answers. Jamie Cox, a marketing partner at Harris Financial Group. Dan Schaefer, the CEO of Schaefer Asset Management and author of Profiting in Economic Storms and author of the book You Can Never Be Too Rich, Alan Haft. Welcome all. Dan, I'm going to start with you. Year-end distributions for mutual funds could get ugly for some people. What can we expect?
Well, if you try to buy your mutual fund before they make their distributions or go ex-dividend, which means after they make the distributions, then you're basically going to be paying tax on earnings from that fund that took place during the previous year back to January 1st. So if you weren't an investor, you didn't take advantage of that, your fund could actually be down and you could still have a capital gain distribution.
Ouch. Alan, what's your advice to people? I mean, look, some people out there right now are trying to buy funds. You certainly wouldn't want to buy one of these funds right now and then take that tax hit when you haven't owned it the entire year.
Right. First off, if you buy a fund right before the record date, you're essentially buying yourself a tax liability. Gerri, I say avoid the problem altogether. Stick with exchange-traded funds or index funds. For the most part, exchange-traded funds, because you'll get rid of this problem altogether. You control the taxes, not some fund manager out there.
But Jamie, look, if I put this into some kind of retirement fund that's tax-sheltered, I don't have to worry about it, right?
That's right. If you have an IRA, Roth IRA, 401k, any of those, these mutual fund capital gains distributions are not a factor. In addition, Gerri, there are two types of capital gain distributions, long-term and short-term. So this really hasn't been an issue for investors generally for the last couple of years because of the 2008, 2009 crisis. There were all these carry-forward losses, but this year, actually, all those carry-forward losses have been exhausted, and there is going to be some capital gains.
Ugly news, and the mutual funds are posting this on their own websites, or they're telling you directly. So keep an eye out for that, my friends. It could get ugly. I want to talk a little bit about too big to fail, because we're talking about some of these companies that you're used to investing with, maybe it has your 401k, who could get in trouble here. They may be subject to too big to fail rules from Dodd-Frank. That's what the Treasury is talking about right now. Big considerations. Well, Barney Frank's saying, and he helped write Dodd-Frank, he said the Financial Stability Oversight Council has enough to do regulating the institutions that are clearly meant to be covered, the large banks. I've not seen the argument made yet to cover the very plain vanilla asset managers. Alan, you're frowning at me here. I see you're thinking about this issue. Tell me what you make of this. I've got to think that at some point, individual investors would get hit with the cost of this. It would come to rest on our shoulders, and none of that would be good, because you know even a 1% gain in fees in a 401k can be destructive.
It's a great point, Gerri. Look, if I put my money with the bank, I do want some regulation on it, because I want to know that I'm getting my money back. And it's nice to know there's regulation out there preventing a bank from making risky investments with my money that might preclude me from getting it back. But if I put my money into a mutual fund, let's say, and my expectation is maybe I'll get all my money back or maybe I won't, I don't know how much regulation there needs to be on that. I think that the onus is on the investor to understand what they're investing in. If regulators come in to try to prevent those losses, it's higher fees for us.
Well, you know, we've seen some 77 different regulations added because of Dodd-Frank at a cost of $15.4 billion for consumers and businesses. Dan, I know you're not a fan of this either.
Oh, this is the most ridiculous thing I've ever heard. An asset manager is not a bank. They're two separate entities. An asset manager doesn't have the kind of systematic risk that a bank has, because the bank's using its own capital. So you're not going to bail out an asset manager, you're going to bail out a bank. So there should be no regulation on an asset manager, because this is not a liquidity issue. You know, the systematic risk is a liquidity issue. If I'm managing it, which I'm a money manager, I'm managing assets for clients, I don't have a liquidity issue. In fact, I add liquidity to the system, and my clients even get a rebate from the exchanges to put orders in.
So, I mean,
doesn't make sense.
You know, I'm always amazed at the level. You know, you assume that Washington has some understanding of basic economics, but they don't always. Yes. I want to go to one other topic here, and Alan, I'm going to pick on you. News this afternoon that Congressman Alan Grayson ripped off, basically by a scammer. He lost $18 million. This is a guy who sat on the Financial Services Committee. He was the first president of IDT. This is a guy who is not stupid. How does this happen?
You know, I hear this all the time, especially with clients of mine, and people come into the office sometimes. They want to know, is it you know, how can I know if somebody's a scam or not? Keep your money. You know, the big problems in this world, like happened to the senator, is what happens when somebody writes a check to a private entity that's holding the assets or that's responsible for investing those assets. For the small investor out there, you're so much better off putting your money into a big brokerage where a financial advisor is nothing but an intermediary for that account. So that's what really solves all the problems. Keep the money in the big institutions.
All right, Dan, last word here quickly.
Well, you know, with the asset manager side of it, I don't hold assets, so no clients make checks to me, and that's what I think we're talking about here, is make sure that your check is with an institution, a custodian, a clearing firm, not to the asset manager.
Correct.
The beat goes on. Even the smart people get taken. Jamie, Dan, and Alan, thanks for coming on tonight. Great job,
Thanks for having
guys.
us.
Great advice.
Thanks.
We'll be right back.